All right, I'm going to go ahead and get started and people can join us as they are able to. Welcome to the webinar. My name is Jen Weiss. I am a Senior Policy Associate at the Nicholas Institute, part of Duke University. And on behalf of our partners at Appalachian Voices and the North Carolina Justice Center, we'd like to welcome you to our webinar today. This is part of an ongoing webinar series that we've been having as part of the Southeast Energy Insecurity Initiative. This one today is focused on creative financing options, green banks, on-bill and PACE and other things. And so it's going to be a really educational and I hope very encouraging discussion that we have today with our subject matter experts. So thank you for joining us. So just a couple of logistical things very quickly. The webinar will be recorded and I will be sending out the recording later, probably early next week. I will also send the slides. And so you can, if you are unable to make the entire webinar or you want to share it with your colleagues, please feel free to do that. We encourage that. There are going to be quite a few people on this webinar, so please keep your lines muted. We will have opportunities to ask questions in the panel discussion at the end where you might be able to unmute your lines. But while the presenters are presenting, please make sure to keep yourselves muted. That being said, we'd love your questions, so please use the chat function along the way as you have a question, and we will try to answer those either as the presenters are presenting or at the end in the panel discussion. So I think many of you have been part of the Southeast Energy Insecurity Project since we started in January, but for those that aren't, I just wanted to give a very quick overview of our goals. Why are we doing this project? Why are we all coming together to talk about this? If you're joining us today, you probably know that energy insecurity in the Southeast is an issue and it is a problem. And so part of this project that we want to do is to measure and characterize the causes and impacts of what's happening in the Southeast. We want to elevate the discussion around energy burden and insecurity so that we can do the second bullet, start to devise regional sustainable solutions to address energy insecurity. We have about 6 working groups with over 150 people working together right now to come up with these solutions that can help to address energy insecurity. And part of this is this collaboration, this fostering of collaboration between leaders like yourselves that are in this space to come up with these new ideas, to look at what's working well in other parts of the country or in other states, and to really devise a plan for how we are going to address it in the Southeast. So I'm really excited that you all are here. Our agenda today is to dive more deeply into one of the areas that has come up in the programs and financing working group. We've really started to talk a lot about a few creative financing mechanisms and found that we didn't have enough time to talk about them in depth during the actual working group meetings, but we wanted to get some experts together to talk about them in more detail on this webinar. So today, after the welcome and introductions, we're going to be talking about green banks. We're going to be talking about inclusive on-bill financing programs. We're going to be talking about property assessed clean energy or PACE programs. And then at the end, we'll have a panel discussion about how can we use these programs to be successful at reducing energy insecurity? What can we do? What can we pull from these different programs to be successful? I am super excited to welcome these 3 subject matter experts. I've known all of them for years, and it's just a joy to work with them. They are incredible human beings as well as experts in their field. Duan Andrade serves as the Chief Financial Officer and Chief Strategic Officer of the Solar and Energy Loan Fund in Florida. She co-leads the organization and is responsible for raising public, private, and philanthropic capital, overseeing the financial operation, risk management, and loan portfolio performance, and developing innovative financing programs to help low and moderate income populations gain access to affordable capital for sustainable home improvements. She has held positions in banks and microfinance institutions in the United States, Bolivia, and Mexico, and also spent many years as a consultant for startups and innovative financing programs focused on social, environmental, and economic justice. She is a Bachelor of Arts in Political Science and Economics from New York University, where she graduated after attending 2 years at Sophia University in Tokyo, Japan. She also holds a master's in business administration from the Harvard International Institute for Development in cooperation with the Catholic University of Santa Cruz, Bolivia. Also, I can keep going on and on. She is a development finance certified professional. So just an incredible long line on her resume. Miguel Llanes is a senior associate for the Environmental and Energy Study Institute's and Access Clean Energy Savings Initiative. That's a mouthful, sorry, Miguel. He works with utilities and other stakeholders to develop inclusive financing programs that increase affordability, expand access to capital, and advance equity of clean energy upgrades and beneficial electrification for all. As part of that work, Miguel assists utilities in developing equitable on-bill financing and beneficial electrification programs. Prior to joining EESI in 2014, Miguel served as a market research analyst for Abigoa Solar in Washington, D.C. He holds a graduate degree in urban policy analysis and management from the New School University in New York City, go New York, and an undergraduate degree in geography and urban planning from the Complutense University in Madrid, Spain. And last but certainly not least, Doug Coward joins us also from SELF. He has more than 3 decades of professional experience in Florida as a planner, a clean energy policy expert, a small business owner, and an elected official, serving 12 years as a St. Lucie County commissioner. Now he's been the executive director of SELF for 10 years. He attended Florida State University, earning a master's degree in urban and regional planning with an emphasis on economics and the environment. He has received numerous awards, including Most Outstanding Green Elected Official, love that one, from the South Florida chapter of the U.S. Green Building Council, and Outstanding Local Public Official of the Year from the Florida chapter of the American Planning Association. He has been described by the Florida media as an unusual combination of environmentalist, a smart growth proponent, and business advocate. I love it. So welcome to our speakers. I am now going to introduce our moderator for today, Alicia Brown from the City of Savannah Sustainability Office, and she will be taking over, but I wanted to give you a little background on Alicia. She is an energy analyst for the City of Savannah Sustainability Office, where she is responsible for developing projects and programs in line with the city's goals to use 100% renewable energy by 2035 and achieve net zero emissions by 2050. Previously, Alicia worked for the Mississippi Public Service Commission through DOE's Solar Energy Innovators Program, where she worked to make solar more accessible through net metering reform, the development of a solar rebate program, and a pilot project for solar on multifamily housing. She has also worked with the nonprofit Liberty Homes to promote the pay-as-you-save on-bill model for energy efficiency. Alicia has a Bachelor of Science in Chemical Engineering and graduated from Mississippi State University. So welcome, Alicia, and I am going to turn it over to you.
Thank you so much, Jen. Good afternoon, everybody. I think it's afternoon at 12 o'clock. Thank you for having me to moderate this panel. I'm very excited to be here because Savannah is working towards 100% clean energy, and we are looking at all of the models that we're talking about today as a part of that process. We're looking at partnerships with SELF, the Green Bank in Florida. We're also looking at pay-as-you-save through our water utility and looking at PACE because Georgia has legislation. So excited to talk about those models today and think about some ways that we can use those in our cities and universities and utilities to reach our clean energy goals. With that, I'll turn you over to Dewan to start talking about green banks.
Wonderful. Well, thank you so much. Thank you, Jen and the Nicholas Institute at Duke University and the Energy Insecurity Project. It's just been such an honor to be on the advisory committee for this project and to share all this information, experience, and to learn from everybody as well. It's been an incredibly enriching conversation throughout the last couple of months, but most importantly, I just want to focus on the fact that we talk about solutions because we know that in this world, there's enough talk about the problems. And I think that what we are here to do and that what we're focused on is really solutions. So thank you, Alicia, and everybody on this panel, including Doug Howard, the founder of SELF. And what I'm going to present to you today is kind of a big picture on green banks, what green banks are, what we do in a very broad sense. And then I'm going to hone in on SELF, SELF being Florida's green bank, and also so far, the only green bank CDFI, which is a community development finance institution, focused on low and moderate income communities. So with that, can we move forward? Thank you. I am borrowing these slides from the Coalition for Green Capital. We are founding members of the American Green Bank Consortium. So just for you to know that the Coalition for Green Capital groups the 23 green banks across the nation. And basically the green banks across the nation have caused over $2 billion in investments thus far. Green banks are really, let me clarify, they're not banks per se, but rather they are loan funds. And these banks can be publicly funded or independent nonprofit loan funds, which is what SELF is. There are 23 green banks across the nation, and green banks in general are leveraging public capital 3 to 8 times. And I'm going to talk about that a little bit more. Our goal is to do volume and scale of green projects on multiple levels and in multiple markets. Next, please. The green banks are institutions whose purpose is to build, deliver, transform, and generate demand by drawing investment, this public-private philanthropic capital coming together and unlocking possibilities and opportunities to invest in green projects. And that covers energy efficiency, clean energy, climate resilience, and even water quality issues. Basically, we're connecting capital markets through the green banks to the project deployment. So our mission is to use a diverse set of financing tools to mitigate climate change. We are dedicated to increasing and accelerating investment in clean energy goods and services. We're raising this capital, blending it together, making sure that it remains flexible so that we can allocate it to the purpose. And it is adequate because the reason why there is no, there's not more investment in the sector is because of the typical underwriting and traditional capital restrictions. So green banks make sure that this capital is flexible and can be deployed adequately, and we're underwriting energy savings and clean energy and other things that traditional entities don't do. So we're going to use different methods, different tools, and we're going to talk about some of them today. Next, please. So this is just a map of where green banks are. There are some great examples. SELF is one of the smaller green banks in the group, like I said, but we are really the only ones that are focused on these LMI communities. So we are doing a little bit of a different model than the rest, but we have like Michigan Saves uses a loan loss reserve to catalyze investments in low-income communities. Connecticut Green Bank issues green bonds to finance huge projects, a couple $2 billion. New York Green Bank works closely with NYSERDA. Anyway, they're just for you to know, there are many green banks out there and many being started every day as we speak. So next, please. So basically, I like to think of green banks as, we had this conversation about it being like a tool shed, not a toolbox that's too small. It's really like a tool shed where you have many tools in there. Some of them are, I mentioned green banks, loan loss reserves, unsecured personal loans, like what SELF does, secured loans, PACE, on-bill payment plans that Doug and Miguel are going to talk about today, and many more. And really what we're trying to do is not only ensure there's capital flow towards these projects from that diverse source, but we're also making sure that this financing is inclusive. So we have different ways to finance solar projects. And as you know, depending on where you are in the country, there's going to be different policy landscapes. So there's not a silver bullet. There's not a one size fits all. So green banks are very good at customizing these programs and ensuring that we can do solar financing with community solar models, PPAs, leasing, personal loans, pay-as-you-save models. I mean, there are a variety of tools out there. We're also obviously focused on energy efficiency, and importantly nowadays, and very much a part of the conversation, is climate resilience. And all of this with a focus of making it inclusive to reach underserved communities, reduce energy burdens, increase climate resilience for the most vulnerable communities that are the ones that also have the most to benefit from these tools and these organizations. Next, please. So I want to talk a little bit about SELF and the solar, which is the Solar and Energy Loan Fund. We go by SELF mostly, and Florida's Green Bank, and what we do and how we're a little bit different. We are a community development finance institution certified by U.S. Treasury. Sorry, next, please. We were started in St. Lucie County in 2010 with a $3 million grant from the Department of Energy, which was part of the American Recovery and Reinvestment Act post-housing market crash. So this was part of a stimulus package, much like what we're living today through the Jobs Plan and the Jobs Act, sorry, that right now is the stimulus package on Biden's agenda, but also recovering now from COVID. And unfortunately, the economic conditions are similar, although the cause are very different, of course. So what we discovered during this last crisis and the pandemic is that what we're doing has a huge value add, and it really is much more than energy and solar and kilowatts. It really is about human conditions and the basic necessities that we need to focus on. So SELF has been focused on the residential sector and helping single-family homeowners access affordable and flexible financing to do critical home sustainable upgrades, such as replace roofs with fortified roofs so they can withstand storms and hurricanes, at least with a better chance of saving their asset. Replacing high efficiency air conditioners so they could play, study, work at home during these times in which we have to still, in many cases, be performing most of our activities from the home. And also so we can preserve health and mental health and productivity. So SELF is really focused on the home and the residential sector. And one of the innovations that we had was advancing all these social, environmental, and economic impacts in the low and moderate income sector, focusing on single-family households and now on affordable housing in order to create social impacts. Next, please. So our mission really is to rebuild and empower underserved communities by providing access to affordable and innovative financing for sustainable property improvements. And this includes energy efficiency, renewable energy, storm mitigation, water quality, and even disability and aging in place, because we recognize that, you know, the home is where people will end their lives. And in Florida, we have a large population of elderly people coming to retire, and those people live on fixed incomes. They may own their home outright, but they don't have high credit scores, or they don't have a lot of income, but they can certainly afford to repay a small loan to make sure that their home is protected. Next, please. So we have basically two levels of programs, a single family and then a multifamily affordable housing product that we're in the process of developing now. Next, please. So this is just a picture of kind of how we look at the home and how we embrace everything that has to do with energy, climate resilience, clean energy. So we will finance all of these improvements to make a home sustainable and safe. Next, please. So basically, our main program focuses on providing unsecured small loans based on ability to repay, not income or credit scores. And our target market are the low and moderate income homeowners, which are basically working class Americans that make up about 40% of the American population, that also are typically underbanked, living paycheck to paycheck, and don't have a lot of savings to respond to emergencies. However, they do have income and they are credit worthy regardless of credit scores. And we have proved this over time. A person that may not have credit or have very little credit because they never used that much credit. A person that had some difficulty, medical bills. We don't believe people should be punished for getting sick. So we do a deep dive in our underwriting process to determine the ability to repay and the credit worthy of somebody based on a combination of factors, including credit history, not credit score. In the process of our lending, we also help advance financial inclusion. If we go to the next slide, please. And we advance financial inclusion, but we also offer a variety of options for people to be able to access financing for their home improvements. So these are just some of the programs that we have, but I do want to talk about the Kiva program. So one of the things that we can do as a green bank and a CDFI is bring in capital from diverse sources. And one of those is crowdfunding. So the Kiva program, for example, is one that basically is able to bring in funding from all over the globe in a peer-to-peer lending model that's crowdfunded and can basically allow for people with 0 credit scores to 500 credit scores, our hardest hit, most vulnerable clients, female heads of household, US veterans with low credit scores, access our lowest cost loan. We're able to raise $10,000 loans through Kiva, and many times we see about 300 people from 4 different continents funding one of our loans. And we've been able to raise about $1 million through this program alone. And then we have different more specific programs for different target markets. Next, please. So I was talking about some of the other services and benefits of our programs, and this is financial inclusion. So people that take out a loan with Self also are able to rebuild their credit and then move on and, you know, access more financial options. The project management is very important because we approve a loan based on a project quote that is given by a contractor that has been pre-vetted and is part of our contractor network. So we are very, very keen on protecting the client and also protecting the contractor. So the client is insured, is guaranteed that their project will be done to satisfaction, because when we approve their loan, we will pay the contractor upon completion and the contractor producing documents that show that the project is in compliance and the client is satisfied and all inspections are met. On the other hand, the contractor is guaranteed that they're going to get paid because they're not depending on the person to pay them, but on us. And they already have a contract with us and they've been pre-vetted, so they're going to be paid directly by us. The other thing that happens with our contractor network and our contractors is that they're able to generate and produce more jobs. So the job part of this is another important thing that green banks are focused on, is creating jobs in the green sector. And Self, for example, is able to affiliate contractors at no cost and help them open up new markets. So where contractors before could not go and serve these communities that have blue tarps on their roofs or need new high efficiency air conditioners or may be ready to go solar, now they can go into those markets and offer their services and their products with our financing options that are much more accessible to low and moderate income communities. Next, please. So Self basically has raised about $28 million to date, which isn't much in comparison to other organizations, but for an organization in Florida that has no favorable policy for energy and climate and solar, we have really had to rely on our own capacity to raise public-private capital without any assistance from, for example, state funding. Other green banks are able to start with state funding, which is a great thing. In our case, we've had to recur to faith-based organizations, CRA bank investors, impact investors, health organizations. And with that, we've been able to raise this capital, which is now leveraging about $90 million in projects. And that is because some of the grant capital that we received for loans is equity type capital that we're going to be investing now in green affordable housing, trying to raise the standard of affordable housing to be more climate resilient, to be less, more energy efficient, and to reduce those burdens for low income tenants. So we're coming in with a piece of the capital stack that will unlock these opportunities to raise the standard in affordable housing. And that means that, for example, the JP Morgan Chase $5 million that we were awarded in 2019, we're going to be leveraging $65 million from LIHTC and other private capital to be able to do 300 affordable housing units that are climate resilient. Self has deployed so far, it's a little outdated, it's probably closer to $20 million right now, in over 2,200 unsecured loans. Now people say, that's crazy. How do you give an unsecured loan to somebody with a low credit score and expect to, get repaid? Well, 74% of our clients are low to moderate income and have low credit scores. About 56% of them have low credit scores. And our average default rate is less than 2%. So again, we are able to do things in a non-traditional way and get very good results and raise capital in the market to be able to do our work. Next, please. So we have special programs, and I'm going to go through this quickly. So Jen, if we can just kind of go through this, and I'll describe a little bit about this. We're launching a new program in Atlanta, Georgia, to motivate, incentivize landlords with properties, rental properties for low-income tenants to make energy efficiency investments. So basically, we're working with the Atlanta Housing, who is able to provide a rent boost and motivate landlords to make these investments. And we're bringing in the capital at low cost in an unsecured way to help elevate the quality and the standard of low-income housing. And then we're also providing gap funding for these new affordable housing developments. Next, please. We also work in very close partnerships with local governments and utilities. In this case, we developed the Septic to Sewer Conversion Program, where Martin County Utility collects for us on bill. But we leveraged their capital. They had $200,000 to do 22 projects, and we leveraged that with $2 million, and we're going to do 200 projects instead. So that's another kind of innovative program that we developed. Next, please. And then we have inclusive solar loans. And if we can move to the next, please. And just to show you a couple of examples, this is a US postmaster that didn't have access to financing. He had a relatively low credit and thought he would never be able to get a loan for solar. We were able to finance him. Next, please. I don't want to go into the details. This is all in the presentation, and I purposely left a lot of details, so anybody wants to go back and check out more detail can do so, but I want to make sure that I leave enough time for my colleagues. And I think that if we can move forward, Jen, please. I do want to highlight, for example, one of the things, again, that as a green bank, we're able to do is we're able to raise philanthropic capital. And in this case, we raised $200,000 from the Leon Lowenstein Foundation to be able to pilot a first rooftop solar project on a public housing building in Miami-Dade. And this is going to be emergency response solar system with battery plus storage to be able to protect vulnerable elderly residents in the case of power outages. So it's basically going to power up the main areas, emergency areas, and keep their medications cool in the case of power outages. Next, please. So this is Sister Corrin here in the middle between Doug and myself. She is a faith-based organization, a nun, who is the juggernaut in socially responsible investment. And thanks to Sister Corrin and the faith-based organization, Self was able to get to where we are now, really. They understood the connection between social justice, environmental justice, and they invest patient capital in organizations such as ours. So I am going to wrap it up there. And if you can go ahead and see the impact stories. And if you can stop 1 second on the previous one, previous slide. Yeah, so I just wanted to end with this. I'm sorry, that's kind of out of whack, but the green banks really are producing these social, environmental, and economic impacts. And that's what we're focused on. And if you can see the next slide now, this is kind of, where you say a picture is worth 1,000 words. This is a US veteran single mother who was recovering from cancer. Her roof was caving in, could not access any loans for her to replace her roof, gain access to insurance, and protect her health and well-being. And this is her after she recovered and has a new roof through Self and has a healthy home. So with that, I am going to hand it over to Alicia.
Thank you so much, Dewan. And to everyone who has submitted questions, thank you for those. We are going to deal with those after everybody has had their chance to present. So continue to send those in and we will try to answer as many of your questions as possible after our next two speakers. With that, I'm turning it over to Miguel.
Thank you, Alicia. Hello, everyone, and thank you for being here on this great webinar today. So my name is Miguel Yanes Manuevo, and I work for the Environmental and Energy Study Institute, a nonprofit based in Washington, D.C. So here today in this webinar, I'm going to be talking about accessible financing for clean energy development. Next slide, please. And so ESI is a nonprofit that has been around for more than 35 years. And we do a lot of educational briefings for policymakers, provide a lot of on education for them and the public in general on clean energy and transportation issues. And a lot of my work also revolves around direct assistance, providing assistance to no-cost assistance to DDs who want to develop and launch inclusive home-built financing programs for clean energy, energy efficiency, and beneficial notification programs. And so that's part of our mission to help communities around the country reduce carbon emissions and create solutions, as Juan has mentioned, to help communities everywhere be able to reduce their impacts on climate change. Next slide, please. And so there's a lot of there's this crisis, this climate change crisis, and we know that there are solutions out there, clean energy solutions, and we know that the costs are coming down, but there's still a lot of barriers that don't make these clean energy solutions accessible for everyone. So Duane in her previous presentation has run down through a series of solutions that green banks can also help. And so there's a lot of lack of energy affordability for many Americans to afford clean energy solutions that will then help them reduce their energy costs, reduce energy burdens, and reduce carbon emissions. There's barriers to high upfront costs and the lack of access to clean energy. Not everyone has the credit scores that will enable them to afford a loan or other forms of financing to get them install solar panels or install energy efficiency retrofits. There's also a lot of issues with split incentives, the misaligned costs between renters and landlords that really reduces the ability for renters to participate in clean energy programs, but who are the ones who will benefit the most from these programs. And then there's just the unequal access to clean energy by racial and income lines. And so there's this study by Berkeley University in 2009 that established how Black neighborhoods install 69% fewer solar panels than other comparable neighborhoods, and in fact, and than other even non-majority census tracts. And then there's just many homes and structures that just not adequate and need the investment to in order to install solar panels and in order to install energy efficiency retrofits. Next slide, please. And so one of the solutions is inclusive on-bill financing programs. So through these programs, the utilities are the ones who are financing the clean energy improvements for homes and businesses. And then they are the ones who then repay the cost of the upgrades to the utility through their utility bills over time. And so these programs help reduce energy burdens and energy inequities by improving energy affordability, increasing access to capital, and clean energy. And they do that because they have no upfront payments. All the payments are in the bill consolidated, thereby consolidating the process. And on-bill financing programs, if they're designed to be inclusive, which is something that we do at ESI, they can be done so that they're at least bill neutral, if not cash flow positive. Also, they can be done in a way that there's a quality assurance plan for the contractor to install the energy upgrades. There's energy assessment before the work is done, after the work is done, and then there's modeling so that they know that there is going to be energy savings at the end of the day. Also, these programs don't ask for credit scores. They use bill payment history, a form of underwriting, alternative underwriting, and this allows to expand access for everyone to use these programs, including renters. And one of the design elements of on-bill financing programs is to tie the investment to the utility meter, not to the individual. And so this allows renters to participate. It also allows for a longer repayment periods of up to 20 years. So this really helps to finance solar for 20 years and make it affordable for everyone. Most of these programs are affordable. They're low interest rates, as you will see in the case studies I will present. And also many of these programs, they just use an on-bill obligation, one energy conservation charge rather than a loan. But there's others with loans, and that the important one is that if they're title to the meter, allows them to be transferable to the next owner or renter. Next slide, please. Then I just want to show a map of all the on-bill financing programs that we know that are out there. Many of them are older. They've been around for more than 20 years, but there's a few of them that are newer, that are doing great stuff. They're innovative, they're inclusive. They're really designed to create energy savings, reduce energy burdens for the utility customers, and they're designed in a way that increases access to capital and to improve affordability of the energy. And so one of the first programs I'm going to focus on is on the left hand side, the Hawaii Green Energy Money Savers Program. Next slide, please. So this program is run by a green bank, Hawaii's green bank. And so Duan has talked a lot about green banks and how they can leverage capital. The Hawaii Green Infrastructure Authority developed the Hawaii Green Energy Money Savers Program, or GEMS, an on-bill program that helps everyone, but it's mostly focused on LMI customers afford solar energy and energy efficiency for everyone. So it finances for residential, commercial, for nonprofits, and it's an on-bill tariff program, or a tariffied on-bill financing program that is tied to the meter, It uses bill payment history rather than credit scores. And GEMS is also a program that doesn't use loans, and it uses only an on-bill obligation. That is out of the meter appears as an on-bill, that is as a line item on the bill of the participant, and it's paid over time. This program has really been really successful in the last 2 years, has financed more than $10 million in solar energy. It's a program that ESI has helped develop. And it's a program that is focused on as I said, on LMI household to save energy. And they must demonstrate at least 10% energy savings. Next slide, please. And so here just a breakdown of an example of a participant who has gone through this program. It's an LMI household, and thanks to this program, they installed solar panels, and they saw net monthly savings of about $51, or more than close to $600 a year. That's through the utility bill, and that's before any kind of tax credits. And so they're seeing the real energy savings that this program can help them accrue. So it's not just for urban areas, but also for rural areas. In this case, this participant in the GEMS program lives in the island of Hawaii. Next slide, please. So talking about rural areas, I want to take a moment, and I've been asked also to talk about some of the pay-as-you-save programs that are out there, and they're also newer. And one of them in the Southeast is the Monocle Electric Cooperative Upgrade to Save program, which is a co-op in Northeast North Carolina. And so this program, which ESI had no work at all, it's a pay-as-you-save program. And it's a great program that has been run by the CEO of this co-op, Curtis Wayne, and who is an excellent leader in helping his members save money by providing investments for whole house energy efficiency measures, such as insulation, air sealing, and all these investments are paid over time. This program particularly requires that the installed measures offer 20% net energy savings to the participant. It's been a great program that helps owners and renters finance measures. The data of the meter has done about 5 million in investments. Next slide, please. And so the next program I want to touch upon also in the Southeast is one that ESI has helped develop, which is run by 6 electric co-ops in South Carolina. This is called the Helmet House program, and has run for 9 years, almost 10 years now. And they use right now $13 million in no interest capital from the U.S. Department of Agriculture Rural Energy Savings Program, or RESP, which is a great program that that has helped a lot of co-ops capitalize their programs and help them provide investments for their members in a really affordable way for whole house energy efficiency upgrades. And so this is a program that's it's a tariff program. The loan is tied to the meter, not the occupant. And the participants just need good payment history, not credit scores. But just want to emphasize that beyond these numbers, this program really helps members reduce energy burdens and energy insecurity for homeowners, renters, and also for those families living in manufactured homes. And so just as an example, there's a lot of stories, and there's a lot more that I can go into. But really it's a story of a participant of this program that lives in a manufactured homes and has struggled with her high energy bills. And so thanks to her utility, Tri-County Electric Cooperative, that offers the Helmet House program, she has been able to install energy efficiency upgrades like a new heat pump, air sealing, and then insulation in the underbelly of her manufactured home, which has allowed her to save 38% on her energy consumption. And so even with addition of the monthly loan installment, the repayment, her monthly bills have dropped by more than 10%, $10 a month doing that every single month. And so she's saving $120 on her utility bills. Next slide, please. And so I just want to finish on talking about how ESI helps utilities all across the country, particularly rural electric co-ops, launch and develop and launch on bill financing programs that are inclusive, that are equitable to their members. So we provide this assistance at no cost to utilities, and we work with a lot of stakeholders like everyone here on the webinar. But we really work with utilities to apply for the Rural Energy Savings Program at the USDA to help them then reloan that capital to help homes and businesses invest in clean energy upgrades, energy efficiency, energy storage, and electrification. And so we have helped a lot of co-ops, public utilities, and other entities like the Hawaii Green Bank launch these programs in more than 20 states. We do a lot of best practices and program design to do this work. Next slide, please. So thank you very much for the opportunity to talk in this webinar, and I will be happy to answer any questions. There's been a lot of questions in the chat. I'll be happy to respond them later. But thank you.
Thank you, Miguel. So next we're going to have Doug Coward talk about property assessed clean energy financing. I'm going to turn you over to him.
Great, thank you, Alicia. I hope you can hear me okay. I was having some computer problems, so I'm doing this on my phone, but I wanted to say good afternoon to everyone and thank you for the invitation to participate in this webinar. Next slide, please. I quickly wanted to just echo some of the comments that we heard from Dwan in terms of, green banks and clean energy financing programs really do come in all shapes and sizes. And we're seeing them deployed to meet different target markets and also the unique characteristics in each jurisdiction. And again, I strongly agree with Dwan's comments that there is not a silver bullet. There's not a one size fits all clean energy lending program. And each one offers both benefits as well as potential shortfalls. And I think we really need to key in on those shortfalls and make sure that we've got adequate consumer protections and quality controls. And Dwan was mainly describing the multitude of unsecured lending products that we work with, the CDFI loans, the Kiva crowdfunded loans, the landlord loans, et cetera. And then the only secured lending product that Self offers is a PACE program that we customized and created in St. Lucie County, Florida, which we currently offer CPACE, RPACE, and also PACE for new construction. And Dwan has given the overview of SELF, but I've been asked to kind of key in on our work in developing property assessed clean energy programs. Next slide, please. So I wanted to start with just a quick snapshot nationally. If you take a look at PACE Nation's website for updated information, they state that there's 26 different states plus the District of Columbia with PACE programs. And there are 3 residential programs active in California, Florida, and Missouri. And it appears they've done over $10 billion of PACE projects to date, with most of that activity in the residential sector with about 70% or so. And then Florida actually passed its PACE enabling legislation back in 2010, which I was involved with when I was a county commissioner back in those days. If you're not familiar with PACE, it is a land secured assessment, which is attached to the subject property as a tax lien. And you make payments on that through your annual property tax bill. So the assessment is not attached to the individual, it's actually attached to the property. And I remember when we first developed this program, the county attorney for St. Lucie said to me, Doug, you realize that PACE assessments are not a loan. And that really baffled me at first because I did not understand that. And it's a really critical point to understand in relation to PACE and the mechanism and the basically the oversight or the lack thereof. The PACE assessments are essentially a non-ad valorem tax assessment that's secured based on equity in the subject property, not by the credit worthiness or the income of the individual property owner. So there are no detailed financial backgrounds that are done. And there's also no credit reporting because the assessments are not technically considered a loan. Another related issue is the administration of these programs. You'll see either local governments overseeing them. Some have third-party administrators like SELF overseeing them. But most often what we're seeing here in Florida is the for-profit PACE companies generally are overseeing themselves. What I would broadly describe as a hands-off approach where local government adopts a PACE program and then allows the for-profit company to simply administer and oversee themselves in their jurisdiction. I think broadly speaking that CPACE is widely accepted as viable and a safe tool for clean energy financing. But I think on the residential side, we've seen that it's been plagued with insufficient consumer protections and quality controls. Now, I do note that I am not an attorney. I'm sharing with you my personal experience having developed PACE programs from scratch here in Florida, and then also evolving those programs to try and help address some of these problems. I remain a supporter of our PACE, but I caution you that there are some serious consequences if it goes bad, and I'll be getting into those details in a minute. I would also note that California has really been the national leader in PACE financing, and after several years and billions of dollars of projects and some problems, the state legislature significantly upgraded their consumer protections and the program oversight. And unfortunately, Florida has not adopted those same consumer protections and oversight. So it's still somewhat of what I would describe as the Wild West here in Florida. Next slide, please. This slide is just a quick recap of Florida's PACE enabling legislation, which is 16308. And the specific qualifying requirements are essentially that you need to have paid your taxes on time over the last 3 years. You need to be current on your mortgage debt. And the amount of money that you're allowed to secure through PACE financing may not exceed 20% of the just value of the property as determined by the property appraiser. Now, there are a couple of exceptions if there is a loan holder consent and an energy audit, but generally speaking, those are the minimum requirements needed to secure PACE financing. And again, PACE is an equity-backed lending program. And so it requires the PACE lenders are required that there's sufficient equity in the property, which is more than the size of the proposed assessment itself. And I realize this is a vague comparison, but I would broadly compare it to a home equity line of credit, but with very limited or no financial assessment and verification, or what we would broadly describe as underwriting. And probably most importantly is that you're not required to prove that you have the ability to pay. And that becomes particularly worrisome because, of course, the tax lien on your property, if you do not pay your taxes and you default on the PACE assessment, you can potentially jeopardize home ownership and possibly even lose your home or your business. So of all the lending programs that we work with, this is the program that has the highest level of caution. It needs the greatest transparency, and it needs the greatest oversight to make sure that is being done properly. Next slide, please. I wanted to key in just for a second on some of the problems and concerns that we've encountered here in Florida. And I recently had a chance to review a PACE audit that was done in Collier County back in 2019, which really did a snapshot assessment of what happened, what were the results after 1 year. And what they found was that 69+% of the AC loans had 20-year PACE assessments, which is twice as long as the warranted life of the product. And because of those extended terms and interest rates, a $5,000 or $6,000 AC system was ending up costing homeowners upwards of $30,000 over the 20-year term of that loan. And worse yet, you'd be paying on that 20-year term potentially 10 years after the AC was no longer working. So Florida law says that the term of the loan or the assessment is supposed to not exceed the lifespan. So we see here that almost 70% of the projects are not in compliance with state law in that regard. Another bullet that jumped out at me was that over 40% of the total PACE assessments in year one exceeded the 20% cap in terms of the just market value. And this is something that we've seen in Florida, where the PACE providers are essentially doing an appraisal to increase the just value in their minds, but that's not consistent with state law that requires you to use the just market value determined by the property appraiser. So again, over 40% of the projects were not in compliance with state law. And in those cases, there's no third-party oversight. There's no one who's looking after this program on a day-to-day basis and making sure that it's in compliance. And then probably the most alarming example was the fact that 2/3 of all the PACE projects that were undertaken in Collier County were completed by 3 PACE contractors who were all under active criminal investigation, or their licenses had already been suspended. So again, my point being is that you need to have a third-party oversight, whether that's the local government who has sanctioned the program or a third-party administrator who you brought on to help with these quality controls. I also wanted to share an example of why this is so important. We had one of the larger solar contractors who was operating in the Miami area and using PACE financing there, came into St. Lucie to begin to try and promote his business and sell solar projects. We had a local homeowner come in with a quote in hand from this contractor, and they asked if we did solar financing. We said, yes, we do. Took a look at the quote and said, but we're not doing that. The feedback that we got was, why not, of course? And the answer was that because the individual was about to be double charged for the price of solar. And so we talked with the company who was irate with us. They told us that our job was not to tell them what price they could charge. They threatened to take us to the state attorney's office. And of course, we said, sure, go ahead. We'll be glad to share with the state attorney's office how you're trying to gouge local clients. We then had the homeowner rebid the project with 3 local contractors, and we were able to shave off $20,000 on the upfront cost of the system, get him a market rate, and then finance his project. So someone needs to be looking at these price controls as well to make sure that people are not being gouged by unscrupulous contractors. And then lastly, the other main concern I have about the hands-off PACE programs is just in terms of transparency. Right now, basically, the contractors close the PACE assessments in the field with the homeowners. And I've talked to some of our own contractors who use PACE, and it's clear that they're not familiar with the funding mechanism. And most notably, they're not even aware of the consequences of default. They do not know that if they push a loan on a PACE assessment on somebody who doesn't have the ability to pay and they default, they could potentially lose their homes. So it makes no sense to me that you would have a contractor with no background in lending closing a financial transaction that they themselves don't even understand. So it's something, again, where you just need to have proper third-party oversight and quality controls to make sure that this program is not being abused. Lastly, I wanted to key in on St. Lucie County's Property Assessed Clean Energy Program, which we developed for the county. And we've been working on this program for more than 10 years. And we finally got it up and operational in the last 5 years or so. And we've developed a commercial PACE, residential PACE, and most recently a new R-PACE program. We've done about 86 projects totaling 1.6 million, which is less than 10% of the total lending that we do. So instead of having one lending program and trying to fit everybody into that box, if people come to us, we like to get to know them and figure out which of the programs makes the most sense and provides them with the best terms and rates. So we have different programs that we can transfer them to outside of PACE if appropriate. The other thing that St. Lucie County did at our urging was to actually mirror some of the consumer protection upgrades that we found out of California. And most notably, they voluntarily adopted higher consumer protections than are required by state law. Because our PACE has been plagued with these consumer protections, we really felt like it was absolutely critical that St. Lucie County develop an ability to pay component. And also the county decided that they wanted to retain us as a third-party administrator and rejected all of the for-profit PACE companies due to the lack of consumer protections. And then lastly, I would just note that we try to strictly adhere to state law as it relates to 30-day notices to the mortgage holders, consistency with the just market value, and then of course the limitations on the terms of assessment so that we're not issuing assessments that go beyond the lifespan of the product. And then last slide, please, is just a really quick comparison between the unsecured loans and our PACE. You can see the financing mechanisms, which we talked about already, versus a personal loan versus a non-ad valorem tax assessment, unsecured versus secured. The collection process is quite interesting because we don't need local government approval and we don't need them to collect on our loans, whereas a PACE assessment needs to be sanctioned by the local government, and then the local tax collector actually collects the PACE assessment as a part of the tax bill each year. And then again, the most significant difference, I think, is the repercussions for defaults. If someone defaults on us, their credit score is reduced. There's no risk of property loss, but we must basically absorb that loss through our loan loss reserve. And the one recourse we have is we can go to a small claims court for like up to $5,000. Whereas PACE is actually a very secure investment for PACE investors because the tax lien is attached to the property, not the individual. So if they default and even lose the property, that tax lien survives, and then the new owner is responsible. So it's the potential loss of property, which is the biggest concern. And obviously, trying to promote clean energy, we want to make sure that it's done safely and prudently, and that people are not losing their property. And so I would say one of the, just going to the bottom on the lending terms real quick, I think one of the advantages of PACE are the extended terms. Self typically has loans that are into 5 to 7 years and up to 10, but PACE loans can go out to 20, 25 years. So it's very advantageous. So with that, I'll go ahead and close and look forward to the panel discussion next.
Thank you so much, Doug. So we have been keeping tabs on the questions that you guys have sent in as we have been going through these discussions, and we're going to start with those to make sure everyone's questions are answered. And then from there, if we have some time, just some broader questions about these different topics. So one of the first questions was for Duan, and it was asking you to dig deeper into the Housing and Community Impact Fund. Can you talk about that a little bit?
Sure, thank you very much. This is a new fund that we've created with the JP Morgan Chase grant, which basically is providing capital at low, can you hear me? I'm sorry, I got some weird signal here. Okay, yep. Sorry. Which basically is going to allow us to provide capital for equity type investments into affordable housing developments, whether they're new or rehabs. So I'm going to try and explain an example. We have a project that's brought to us that is for 200 affordable housing units that they want to make them climate resilient, energy efficient, and even put solar on it. The developers are able to raise capital of up to 90% of the capital stack with LIHTC and private capital and all, LIHTC is low income tax credits and other financial instruments. But then there's a 10% that usually is that's needed, and usually comes from private investors or private equity investors or just traditional lenders. That capital is coming in at around 15 to 16%, which then cuts into the profitability of developers, which then demotivates the investment into these higher standard green affordable housing units. So we decided to create this fund to fill that capital stack portion. So it's basically up to about a 10%, 8 to 10% of the capital stack, where Self would come in with lower cost capital, 5 to 6%, equity type, to facilitate and to really unlock that new standard of affordable housing and not kind of hinder the appetite for profit that developers have. Because, we cannot change the industry and ask them to not make profit. What we can do is change the capital stack in a way that still works for them, but also really advances and pushes the envelope on the standards for affordable housing units. So the HCIF is meant to fill that purpose, to meet that purpose. And we are open for business. We don't have a huge amount of capital yet in that fund, but the more people approach us with projects, the more capital we are able to raise for that fund. I hope that helps.
Yeah, definitely. And just to clarify, that's new builds and renovations, right?
Yes, yes.
Okay, yeah, it's good to know. Thank you so much. Next question I have is for Doug. So it's for PACE. You have those property assessments, and I think it's getting at this idea of someone selling their home. And if you sold your home with a PACE assessment still in place, would the new owner be liable for those property taxes immediately up front?
Yes, it is another issue that, I think creates an additional burden because obviously many of the mortgage writers do not, do loans that have PACE assessments on them. So generally what we see happen is that people with PACE assessments who are selling their home will actually typically pay off that assessment as a part of the transaction. That's the most common thing that we're seeing happening.
Thank you for that. This next one probably can touch on all three of you, so I'll kind of let you fight for it. Are there any best practices for vetting contractors participating in an on-bill financing program? And I feel like that would probably extend to PACE and Self's Green Bank programs as well.
I would say that, and that's a really good question. It's really important for any kind of financing mechanism to have good contractors that would install, that would adequately install the clean energy upgrades that would be then provide energy savings for the participant. So there's a lot of good practices. For example, it's important that the contractors have been registered by the Better Business Bureau, that they've been vetted by other organizations that have been paying their taxes. The organizations have their taxes, and also that they're licensed contractors. It could be BPI contractors. And especially contractors that are specialized in their field, either insulation or HVAC contractors, heating, ventilation, and air conditioners. And so, for example, I was talking about the Hawaii GEMS on-bill program. They have a very, in the website, they have a very detailed step-by-step on how they vet their contractors, also provide some training opportunities for them. But in those cases, in on-bill programs, it could be, the utility could be more on hands to take all those responsibilities of training the contractors, vetting them, or at the same time, they can also look at the contractors on that are not just on the that are in the area where they provide the on-bill program services. I hope that answers the question.
Yeah, it does. So, as we wait for more questions from the audience, one that I had for Doug is, a lot of states have PACE legislation, but very few have actually gone through with programs. I believe it's actually just California, Florida, and Missouri, if I remember correctly. If a state has that legislation and wants to look at a program and basically fix the problems that have been identified in other places, what advice would you give to them? What recommendations would you have?
Alicia, if I can just for a second back up to the last question real quick, and then I'll jump into this, the one you posed, but I just wanted to add in terms of best practices on the contractor side. What SELF does is make sure that the contractors have proper license, insurance, track record, and it also requires ongoing oversight to make sure that those stay current. And then we don't pay a contractor until the end of the project, after the local building official is signed off on it. So that also provides some additional security. And then we provide oversight, project management on the quotes as well, to make sure that before we approve the project, we've looked to make sure that there are competitive rates. To the question in terms of PACE, I personally think California's upgraded consumer protections are the standard. At the very least, the most important issue in my mind, there's two. One is to incorporate an ability to pay component. Again, since PACE is not considered a loan and doesn't require a financial background check or proof of ability to pay, and it's a tax lien that can potentially through default make you lose your home, it would seem to be a standard that should be established across the board. And I'm hoping that the PACE industry does incorporate ability to pay. It's absolutely critical. And then the second recommendation is to have some type of third-party oversight. You don't want to have the for-profit PACE companies overseeing themselves without having either a local government or a third-party administrator looking over each of these projects to make sure that the homeowners know what's PACE assessment is, to make sure the pricing is fair, and so forth and so on.
Thank you for that. I'm going to go ahead and throw you another question that just came in the chat. This question is asking if there have been any successful partnerships between weatherization assistance providers who do energy audits and contracting management and PACE programs. So basically, instead of just a contractor who's not used to doing like the audits and everything, signing people up for PACE, people who do the audits that have a standard for savings.
Yeah, if I could jump in, we work in two regards with state certified energy auditors. We can finance their work, but oftentimes they're providing information to homeowners about what types of improvements need to be made. And then of course, SELF provides financing specifically for that purpose. And then more commonly is that most of the utilities have some form of a free energy audit. Typically, I would describe it as like a clipboard audit. It's not a detailed one, but they provide those audits to homeowners. And in areas that we partner, the utility will then also provide information about our assorted clean energy financing program, so they know not only what to do, but also it provides them a means of actually achieving those specific recommendations.
And actually, sorry to go to you 3 times in a row, but this next question in the chat, when any of these financing mechanisms be viewed as an encumbrance on the title in a title search that must be resolved prior to refinancing or sale? I'm assuming PACE, maybe not the others.
Yeah, if I can jump in on that one, just to be very clear, PACE is, in our case, the only program that we have in our toolshed that it has an encumbrance. It basically is a property tax ad valorem or voluntary assessment. So absolutely. And it also takes first position over any mortgage. So when somebody's trying to sell a property, whether it's a house or a commercial property, because again, there has to be a very clear distinction between residential PACE and commercial PACE. But when somebody's trying to sell a property, then yes, that will absolutely show up. And in that case, now it's become, it depends where, it's become more flexible in terms of being able to refinance with a PACE encumbrance or lien. But many banks are still very uncomfortable when they see a PACE lien on a property. So a best practice would be to pay off the PACE assessment, before before you want to sell a property. And that's the other reason why, again, this is a tool, but it's not a tool that's adequate for everybody. It's a tool that's adequate for people that can plan on, for example, saving enough money to be able to pay that tax lien at the end of the year. In other words, not pay off, but pay the loan once a year versus in monthly installments. It takes a different kind of planning. So a small unsecured loan is a monthly payment that's easy to make and it's short and you don't forget. A lot of people get sidetracked and then they get their property tax bill at the end of the year and they forgot they put a PACE assessment and now it's $6,000 more on the property tax. And that's where the problem starts for the residential sector. In the commercial sector, it's very different because, you're dealing with a business. So typically you're going to do those projects, you're going to budget for that type of thing. And if, the commercial property can't pay, then that lien stays with the property and passes on to another business, but people aren't losing their homes, so that's why we are very cautious and caution the use of residential PACE, but very much encourage CPACE as a good tool for clean energy projects.
One quick follow-up on that line of questioning. We have someone asking if the payoff for a PACE assessment could be included in a contract for sale or a contract for refinancing.
Yes, it can, but again, it's going to depend a lot on the new financing, entity. They may ask for it to be paid off before. It really depends, but yes, it can. Legally, it can. It should be able to be included in a refinancing package.
Yeah. Next question is one that came to mind for me while we were going through Miguel's slides. So Miguel or Dewan should be able to answer this one. But I believe in 2020, the Rural Energy Savings Program, USDA loans appeared to become available to green banks. So is that something that could perhaps get some lower cost capital out there for some of those truly low income customers who need cash flow positivity to even be able to have an ability to repay?
Yes, no, I mentioned the Rural Energy Savings Program, RESP. It's a great program that is administered by USDA. It's been going on since 2016, and ESI we've been a part of many of the applications that RESP has done in the last 5 years. And yes, the programs as of April 2020 has expanded not just to green banks, but also to other entities like public water utilities that serve rural areas, and to CDFIs and to state agencies. And so it's a program that's really for rural areas. So the intended borrower has to be an area that has less than 50,000 people, and the borrower which needs to have collateral to provide in order to repay the loan back to USDA in 20 years. And so that's very important because USDA has been able to have a good track record and a really high repayment ratio. This program, which is authorized by Congress and it's also appropriated by Congress, has been able to have a 1 to 20 leverage ratio. So right now there's about $10 million in appropriations, which is leveraging about $230 million in no interest loans for clean energy. And so ESI has been working a lot, because we're based in Washington, D.C., has been working a lot with congressional partners, including the Office of Representative Jim Clyburn in South Carolina, to expand this program, to make it high appropriations. And in fact, in the Biden's administration budget has included $22 million for appropriation, which would, leverage $400 million in these loans for rural areas to provide investments in clean energy upgrades. it's a really great program that co-ops, utilities can apply to as borrowers and other entities.
Thank you, Miguel. Had another question come through in the chat, and this one is probably either for Doug or Dewan. Could someone use a self product to pay off a PACE loan? So maybe they're selling their home or trying to pay it off real quick. Could they borrow from self to pay that off?
Interesting question. No, we couldn't. Technically, you couldn't take out a loan for that purpose. But if they're taking out a loan for a new roof replacement, and there is a PACE lien on it for some reason, then possibly they'd be able to do that. But technically, we lend directly for the project, for the improvement. And just kind of a very high level is we authorize and we approve a loan, and then that person gets the contractor quote, the project gets done, and we pay the contractor. So we never actually give the money to the homeowner. So that way we're ensuring, like Doug had mentioned, that the whole process is clean, that there's no price gouging, that the project gets done. When the project gets done, we pay the contractor. So no, our loans are really for projects themselves, not just consumer loans.
I'm sorry, I thanked you on mute. Well, I actually had another question until anything else comes through in the chat. What all goes into the creation of a green bank? Like, I know that cities and states and even some have started with utilities. What is that process like?
I think it depends. Yeah, that's a great question. I'm going to start by saying it depends, because it depends on where you are, your leadership in the state. So I'll give you an example. Colorado just opened up or created their green bank with $30 million from the state. And, Doug and I sit here and say, oh, the things we could do with $30 million from the state, at this stage with all, 10 years of experience under our belt. But that's a really good way to start a green bank, right? When you have that policy and that appetite and that leadership. If you don't have that, then you start like most nonprofits, or businesses start. So it's a combination of a nonprofit and an entrepreneurial model, because you have to make your model sustainable. You have to be able to prove that you can deploy capital prudently. Again, we've deployed almost $20 million with less than 2% default rate. That helps us continue to raise capital. If we just raise capital, deploy it, not recover it, spend it, then nobody's going to invest in us. So you really have to put together a business model with a mission purpose, so that your mission, your goal is not profit, but it's to grow and generate hopefully a little bit of surplus if you can. We've never really had that situation. But if there's surplus, you use that to expand and grow and serve more people. So in a nonprofit model like ours, when we have surplus, maybe from grant funds, we have to reinvest that in the program to grow and to replicate and to serve more people. It's challenging. It's hard when you don't have state funding to start off with. And SELF had the privilege of starting with the Department of Energy grant. It was a $1.6 million loan fund. And there was $1.2 million for a 3-year setup. So when you're thinking about setting up these green banks, if you're thinking about setting up a green bank, you have to have capital for at least those first 3 to 5 years to support the operations, because otherwise you're going to be pushed to create a model that's profit driven. And then you're becoming one more lender that can't really tap into these markets and unlock these possibilities, especially in an inclusive way. You're going to have to stay at the top of the pyramid and do what everybody else has been doing for the last 30 years, which is stay at the top, cherry picking those profitable projects. What we need to do really is bring all this down to make it inclusive so that every American can benefit from the clean energy economy.
And Alicia, if I can just add, I agree with everything Dwan just said, but there's one other piece I would add is that she talked about making the organization sustainable and developing a business strategy, and that is critically important. So as local governments look at developing green banks, One of the things that you're going to need to think about in that regard is scale, because you need to reach a certain economies of scale to be sustainable. And that's very challenging to do if you're operating in one small local area. And so it probably makes more sense for new states that are wanting to develop green banks to be looking at more of a regional or statewide approach, so that they're far more likely to be able to achieve that economies of scale that's needed.
Thank you for that. Yeah, that's very helpful, because I know SELF doesn't reach quite the entire Southeast yet. So we'll definitely have some people maybe looking at options. And, you see in the news every day that different people are looking at green banks. We have about 4 minutes remaining, so let's try to do 1 to 2 minutes on this question so that Jen can wrap us up. But this last question is, how do renters participate in SELF projects? What happens when they move?
Great question. So renters don't take out loans directly. You have to be the homeowner or first of kin of the homeowner to take our unsecured loans. However, this new program that we're developing with the Atlanta Housing, which by the way, we're about to launch in October in Georgia, is going to provide unsecured loans for the landlords to be able to do these upgrades. So the low-income renter or the LMI renter can benefit from the energy savings. The renter does not directly participate in this program except for receiving the benefits. The landlord now has an incentive to upgrade the home to reduce those energy burdens, because they're going to have access to an unsecured, small, low-cost loan through SELF. But also in this case, the Atlanta Housing is providing an incentive with the option of a rent boost. Now, again, these are the challenges that we still have to really tackle and try and crack that nut, which is, how do we motivate landlords and public housing authorities to invest in energy efficiency, in clean energy and climate resilience to benefit the renters, because the renters do not have control over those residences, but the renters are spending a disproportionate amount of their income on energy. So we have to create something that motivates the landlords that own these homes. And that's what we're trying to do in Atlanta. And I think that that's going to be a replicable program. And again, I think that we just have to focus on rehabbing, retrofitting, and building a new standard of affordable housing moving forward, so that the renters don't have to deal with this energy burden and security problem.
Thank you so much for that. This has been, a wonderful panel discussion, and to all of you still in the audience, everyone on this panel is more than happy to answer your questions and work with you, because there's still problems we're trying to work out. Dewan and Doug will tell you that I'm working with them right now, trying to find a way to do a solar lease product for low-income customers who can't monetize the ITC on their own. And we're still trying to crack that nut, but they are great sounding boards for whatever ideas you're working on in your local communities. So I encourage you to reach out to them with further questions and ideas. And with that, I'll turn it back over to Jen to wrap us up.
Fantastic. Thank you all so much. This is, every time I talk with all 4 of you, I learn something new. So I really appreciate it. As a fledgling green bank, the North Carolina Clean Energy Fund has learned so much from all 3 of you. So I just picked up a couple more tidbits. So thank you guys for your visionary and your leadership in all of this. Thank you everybody for joining us today. Again, this has been recorded. If you weren't able to attend the entire thing, please go back and watch the beginning, and please forward to your colleagues. Thank you to Alicia, to Dewan, to Doug, and to Miguel for just being a part of this and just being such leaders in this space. And I hope you all have a good rest of your day. Thanks. Be safe.